only. So projects with an equal life, I'm saying that this is where you can be able to compare projects with an equal life, two projects or more with different lifespans, so that you can be able to pick as a manager project A and leave B on a fair ground without discrimination, or discrimination that comes as a result of the period or lifespan. Some projects will be able to give you better cash flow in their early years and then less cash flow in their later years. Now, there are two ways of comparing this. The first one is called a replication, finite replication, or we call it constant scale finite period replication. So there are two methods of comparing this. There are two methods of comparing the projects, with an equal life. And the first one is called constant scale finite. Constant scale finite period replication criteria. Finite period replication criteria. Then the second one is called annualized equivalent NPV, annualized equivalent in NPV or present value. Annualized equivalent present value, so NPV or basically value. So you'll find some books writing it as annualized equivalent value or annualized NPV, or annualized equivalent NPV. They mean the same thing. So what are we basically saying? We are saying that the term annualized basically means that the project's life will be different, but then you are now changing their NPVs and assuming that if they were equal, like annually, how much would you get? So it means that you're getting average of those cash flows. You can be getting cash flows that are irregular. Are we together? You can be getting cash flows for project A. For 5 years, they are all irregular, meaning that they are not the same throughout the period. Year 1, year 2, and year 3, year 4, 5 are giving you different cash flows. But then the question is, what if they were annual? They were the same cash flows annually. So it means that you're going to get the NPV that you've gotten, but you get them or the equivalent of annuity value. So that is called annualized NPV. And then we have the constant scale finite period, where you keep on moving the period constantly. You keep on repeating forever. So it is finite, right? Now, I want us to start with an illustration so that you can be able to see how the two are used. And then we do past paper of the same. I'm sure some of you have seen the 2019 question that I shared, November 2019 question. That is a paper that I did. 2019 November paper. It was quite confusing, but the good thing is that we managed, right? So I want us to look at an example and say the cash flows. So we look at illustration so that you can be able to understand this concept well. Items or cash flows, projects with different periods. How do you handle them? So there are two formulas which you have seen. So look at illustration. And then assume that now we have the year. We have year 0, year 1, 2, 3, 4. All right. And then we have project A. So we also have project B. They have their own cash flows. They have their own cash flows. Now, cash flows for the first project, year 0 is 50. Let it be like that. I know that you understand what this means. Maybe Topista, can you tell us what it means? Somebody's making noise. Let me mute. Sitaki ile vita ya jana hiyo. Hiyo sitaki leo. Leo nimetoka church. Sitaki kelele. Topista bado anacheka, anakumbuka. Na waziri aliamua yeye aongei ni macho. Okay, so let's have these projects, and this one only stays for 2 years. So the first period is 200 and then 500. Then we have here 300. Then we have 400. Then we have 600. So year 3, and then we have 500. So obviously, it will be unfair if you stop taking project A because you are seeing that project B has got a longer cash flow or life. But look at the past periods. You'll see that year 1, project A has given you 200. Project B is 400. In year 2, project A is giving you 500, but project B is giving you 400. Now, from your eyes, layman's eyes, we'll say that better you take project A because the initial outlay is only 250 compared to 1,000 here. That's how you can easily understand it. That the cost of investment is less here compared to this, but then the revenues for the past periods are the same. So why would you invest more? But then look at the future. This one will keep on moving and then increasing when this one has stopped. So what do? Is it good to compare those projects? It is not fair to compare them by looking at them. So we have 2 ways. One is called the constant scale finite period, and then we have the other one that is called annuity equivalent value. So even this one, you assume that what could it give you if there were annuity? I'm seeing something. So sahi iko sawa. I hope that the board is okay now. That annuity part I'm going to repeat, so don't worry, just write this one and then we start. So assuming that you're given such kind of questions and then they are telling you the requirement is required, number 1, the net present value of each project using the constant scale finite period replication criteria which you have written. That long Kisungu umeandika tayari. I'm just saying that it is an illustration and I'm giving you this. This is all that is there. This is all that you're given, and I'm reading the question. It is illustration number 1. So I'm reading the question, not from the past paper. Past paper to Jaguza. I normally prefer that first you understand from the basic, so that when you go to the past paper, ukipatana na vitu ngumu hapo, umeelewa from the simple ones. Sasa, so sitaki kuangukia huko, hautaelewa anything ama itakusumbua kidogo. So andika hii kwanza. The requirement is we need to calculate the NPV, which we say that the net present value of each project and using the constant scale finite period replication criteria. Hiyo Kisungu uko nayo kwa kitabu, nilikuwa nimeandika. The second question, that is Roman 2, annual equivalent value, that is AEV of each project. Annual equivalent value of each project. Then the last one, make a decision on which project to undertake. Make a decision on which project to undertake. make a decision on which project to undertake. Now, I say that annual equivalent value, or AEV, is the same as annual NPV, annualized NPV, annualized NPV, annualized NPV. If you guys are there, then we can proceed. Today, I want to move a little bit faster because I have a lot to cover with you, unless you want to do more lessons. Florence, usilie sana. Andika tu, follow the instruction, and then you'll be okay. Usilie sana. Sijaanza mbio, sijaanza mbio. And my nature of teaching, I normally repeat and repeat mpaka uelewe. So don't worry. Wewe andika hii, ukimaliza unaandika Roman number 1, question number 1. Calculate or determine the present and net present value of each project using the constant scale finite period replication criteria. Constant scale finite period replication criteria. That is the first one. Number 2, annualized equivalent value of each project. Then decide which project to undertake. There are 2 projects, so you need to judge them fairly. You need to judge them fairly. Are we good to go? Winnie and Waziri, are we good to go? Yes. Ruth, are we okay? Is Edwin around here today? Is Edwin around? Yes, Edwin is around. There, we shall keep on baptizing you until you change it from your end. Now, we can now proceed. So let's look at the first one. So annualized, the way you do it, the first question, what you do, you get the LCM of the figures. When you are solving the question using the annualized, using the constant scale period criteria, then you have to get the LCM. Who can remember LCM? So you get the LCM of the periods. Like now we have 2 projects. We have project A and B. B has got 4 years lifespan for A. Lifespan for A is equal to 2 years. That is for A. When lifespan for B is 4 years. So they are having different periods. That is 2 different periods. You need to get the LCM of this period. That is the first thing that you do. So you need to replicate. To replicate is to repeat exactly the same things here. But you keep on doing constantly until the periods become equal. So it is constant scale, finite, period replication. You are replicating the period mpaka zitoshani. So you come on 2 years, you will keep on doing 2 years, 2 years, 2 years, mpaka ufike mahali, all of them are the same. Because you could be having 8 years, 10 years, so until all of them are the same, you replicate them. The good thing, these ones are even numbers, and 2 goes into 4. If they were 2 and something like 7, then you have to replicate mpaka wakutane, where they are going to be equal. So that is why you constantly replicate the period. Now, who remembers what we mean by LCM? This thing was taught in class. Topista, which class was that? Primary. Which class was it in primary? Or Jerry, do you remember the class where you were taught LCM? Class 4. Hi, now we have to apply the class 4. So what is LCM? Waziri, do you remember what LCM means? You can't remember. Sasa Waziri, kuna watu wanakumbuka hapa, wacha tusikie vile wanasema. Hii ni politics. Sasa saa hii wewe huwezi kumbuka. If I ask you who was the last minister for health before the constitution was changed, minister for health before constitution was changed, least common multiple, yes, there, that is it. So LCM means least common multiple. And then we have the other one is called GCD. GCD. What does that mean? GCD inamaanisha anyway, as you think about it, okay, greatest common divisor, not divider. Okay, so we are saying that GCD is the biggest number that can go into two given numbers. You can be given two numbers. Now, the greatest one, the biggest number, or the largest that can go in both of them, that is the GCD. Now, LCM is the least number that two numbers can go into. The very first one that both of them can go into. Like for example, now we have LCM of, let's see, so that you can master this well. Let's get LCM of 4 and 3 and 4. What is it? You also give me the one for 3 and 5. Then you can give me 3 and 9. And then 2 and 4. Give me the answers like that. So give me the LCM of 3 and 4. 12. Hello? And who is this person that cannot even wait? Ashapeana answer hata kabla swali ikuje. Thank you. Somebody is too bright here to be in this class. Wewe ende tufanye mtihani. Nelson, umeamua now. So that's what you first look at. The reason is we are looking at the LCM of the periods. We have agreed that project A has got 2 years and then B has got 4 years. So we want a number where you can replicate the period. But if you replicate for project B's period and project 1's period or project A's period, zitakutana mahali where they're all going to be equal. You have to know the number where they're going to meet. So like now, if you were to pick this one here, in case you are having 3 and 9, then you only have 9 goes into 9 once. So you only put it once. Alafu 3, utarudia 3 mara tatu, ndio zote zikuwe 9 years. Now we are dealing with 2. Let's see how it goes. So with 2, you have to repeat B only once because B is gonna 4. So 4 goes into 4 once. So you don't need to replicate this. But now you have to replicate A. Why? Because A needs to be equal, needs to be having 4 years. All right. So you need to repeat A the way it is constantly mpaka ifike. So what we are going to assume is that you are running project A and you have to run it to an extent that it can take 4 years. So that it can take 4 years. So that it can take 4 years. So we are seeing that you are running project A and someone is running project B. So ndio mmalize pamoja, wewe utamaliza the first 2 years, alafu invest again, run for another 2 years, invest again, mpaka wakati huyo pia yake itakuwa imeisha. Tunaelewana? So let's start here. Let's say that you've invested 250 in project A. In year 1, you're going to get some revenue. Remember, umesota. Ukishaweka hii pesa, umesota. So you're only waiting for income. Year 1, you're going to get income of 200. Year 2, you're going to get income of 500. And because you are going to compete with this person, wakati namaliza ndio sasa wewe ndio unamaliza, you are going to take part of the 500 that you have gotten in the second year. You reinvest that amount, inject it in the business again. So that means that at the end of year 2, you will take 250, which is equivalent to the amount of investment, you invest again. So that what we call year 3 will be your new year 1. So in year 3, you're getting another income of 250, and in year 4, you're going to get another 500, a new 500. So we are basically replicating exactly what we are having here to be here. And even if this person was to proceed, you have to replicate it again, take the portion again and reinvest to 50 because ulikuwa umesota. Then reinvest to 50, come and get your equal income. Up to the date, they will all be equal. So you keep on replicating. Same thing will happen with this. If you are to replicate this, then at the end of year 4, you will have to invest that amount. So you minus 100,000, invest again, or 1 million, and then start getting your new income of 300. Now unasonga hivyo mpaka ufike the number of years that are required. What are we saying? That at the end of the day, the periods must match so that you can judge them fairly. So therefore, what will happen with this kind of project is that our end period incomes, our cash flows, this one will now be 250 at this point because you have taken away 250, you invested. So this will be 200, 250, then here we have now 200 and 500. That will be the cash flow to make it equivalent of 4 years. We call it the constant scale finite period replication criteria. You keep on replicating constantly the same 2 years, 2 years, 2 years. So the period is constant, but replicate that 2 years, 2 years, 2 years until you match it. Now, let's now proceed. So you have done the constant scale replication so that the projects are now matching. You now get the NPV of these projects. After that, now, after extending the way we have extended, so what you are doing here is extending the period to match. You've just extended the period to match. Now you can get NPV of these projects. Allow me to wrap, because I'm assuming that you have also extended so that you understand that this is going to be 250 and not just 500, because you took away 250 to reinvest for the next 2 periods, and you have your cash inflows. So let me wrap this. After extension, thank you. So now we can come and get our NPV. So how do you get your NPV? The same way, we are now going to have our, so we can have projects separately. So let's have project A. The period is there. So we have the first inflow, outflow was 250. Then you have 200. Then you have 500 minus 250. Which you know the impact. We only have 250 there to talk about as income. And then we have a new 200. Then we have 500. So there, we can now proceed and get our discounting factor. We can get our discounting factor. So in this case, can we say that maybe the cost of capital is 12%? Yes, take cost of capital to be 12%. They normally give that in the question. I just forgot to give you cost of capital. Assume that cost of capital is 12%. Assume that cost of capital is 12% so that you can be able to get your NPV. So get me year 1. What is the year 0 is 1. Year 1 should be this one. Can you try and get me year 1? What is it? Discount factor. What is the discounting factor for year 1? Get me year 2, year 3, year 4, all of them. Just get me all of them. So I've seen something Willie has shared here. So you're saying that we are having here 0.89, 29, and then we have 0.79, 72. Let's confirm if it is okay. Let's not move with the wrong figures. So then you can be able to get your NPV. Get me the NPVs. NPVs. Get me the NPVs. Get me the NPVs. You can be able to calculate this here and get your NPV down here. So please do that. You get me the figure. Then I go to project B. In number 2, multiply at 50. That is what we are having, the balance. So project B, the same way. So project B, we invested 1,000. The first year we are having 300, and then 400, and then we have 600, and then 500. Those ones remain the same. So get me again the NPV for the second project, or project B. Get me the NPV. Then you compare the two. Compare the two. What are the NPVs? I'm being tempted to wrap them. Just need to know the answers that you're getting here, each case. So the first one is NPV for A. NPV for A is equal to 587. 587.99. That is for A. Okay, and then for B, NPV is B is this one now. What is the NPV? Three, 31.58. Guys, let's agree. Let's agree that speed matters, eh? Yes, kila mtu calculate, si ati Winnie peke yake. Kila mtu calculate, peana answers so that we can move. I know ikifika saa 4, you tell me mwalimu it is time. So, fanya mambo. Fanya mambo. Sawa. So, which one can you take among the two? Which project can you choose? Which project can you choose? Your advice using that formula, which one is the best? NPV. So that is project A. Let's look at this other formula that is called annuity equivalent value, which is Roman 2. EAV. So EAV is very simple. You say that EAV, or what you can call annuity of the NPV value, is equal to the NPV that you have gotten for each project, NPV all over PV per of that project. So let's take example. How do you get PV per? If project A stays for 2 years, then you get PV per for 2 years. If project B stays for 4 years, like that, get PV per for the maximum period. So just check for project A. You will get the NPV after getting the NPV, which we got, it was 587.99 all over PV for that period, for that project. So you get PV per 12%, 2 years. Then project B, the same. So for B, you'll have a 339? 331.58 all over PV per for 12. So this is the NPV, but you are getting annuity for that project. The project was 2 years. So get the annuity discounting factor for that one, then you divide. So that is why it is called annualized. It was NPV, which is okay, but now you say, how can you get the annualized equivalent value of that? So you get the annuity discounting factor, then you divide. So you're going to have this for 4 years. What are you having there? So here we have 587.99 divided by. Kama project is 4 years, put 4 years. If it is 2 years, put 2 years. Whatever. Then you now run them. So it is 2.4018. 2.4018. What is the answer? Someone to calculate for me the second one. nikumbushe ile formula ya PV-FA. Yes, PV-FA is equal to 1 minus 1 plus R negative N all over the whole thing all over R. So we have for 4 years is 3.6048. So we have 3.58 all over 3.6048. So what is the answer? In fact, sorry, this one you should not extend. We are using the NPV when it is extended. You get the NPV when it is not extended. Don't extend this. Can you get the NPV if it is not extended? The way it is, just get the NPV for A without extending before you put it here. So it should not be this one because this one was after extending. So get NPV before it is extended. NPV of A. Project A should have been, we have 20, 250, and then we have 200, then we have 500. Then here, that is the cash flow, right? Then we have discounting factor at 12%. This one was 1. We have 0.8629. 8629, and then we have 0.7972. So we have our NPV without extending. Get me the answer here. I will have to calculate. Yes, that was your question. Yes, you are right, Winnie. Waziri. You get the NPV without extending, because if you extend, then it means that you're now doing the constant period. So just get the NPV ikiwa hivyo. So that was sorry, 0.8629 times 200. So here we have 172.58, and then this other one 500 times 0.7 times 72. We have 398.6. You add the 2. So our NPV should be 321.18. So what we're going to have here is the PV-FA, NPV, over PV-FA, which is now 321.18 over PV-FA. PV-FA you want to be 12.89. Sorry. So it is the wrong one, eh? Should be 89. Sorry for that. 89.29. So therefore the answer here must be different. So do it again, 200 times 0.8929. 178.58. Then 49, 8.6. Then minus 250. So 327.18. 327.18. Is it okay now? Now you take that one and divide by the 1 point. What did you get here? PV-FA for this? PV-FA for year 1? For 2 years, 2 years, 3 years, 2 years. Nelson, what do you get? PV-FA, 2 years, 12%. What do you get? 6901, yes. So 1.6901. Then you get your answer. So that should be 1.6901. So basically, this is now the discounting factor for the annual cost, and then this was the NPV, ya kawaida. You divide it, then it becomes annualized NPV, annualized NPV. So our answer is that 5.9. I believe that is what you guys are getting. Now, this other one, what do you get? This other one was already, we didn't extend this. So the NPV that we had was the correct NPV. So just divide it, and then we say that should be the answer. Just confirm that PVPA is actually 4 years, 20%. Is actually what we are writing there. So I'm going to confirm so that we be sure. Hii. Angalia kama iko sawa. Kuna dot hapa. Confirm that is okay. Confirm that it's okay. Alafu tuangalie past paper. Tuangalie past paper. $345. You're getting 340? So really, you're saying that one is wrong. So it should be 37.3. Like that. Okay, divide and tell me the answer now. This is the time you should have a very strong network. So IUT equivalent is used. It is used to evaluate or to grade projects which are having different lifespans. You either use IUT equivalent, and in IUT equivalent, you get the NPV for each separately. Then you divide with PVPA for each separate, their respective PVPA. But then the other one, you extend. You extend the periods to be equal, and then you get the normal NPV. So what are you getting? So we have 3358 divided by 3.03. 109, 16, thank you. 109.16. So obviously, you can see that the first one is higher. So you can always choose the first one. Or which one is higher? Which one is giving you a higher one? Okay, so now let's look at this one for 2019, exact one, what we are discussing today, the year 2019. This is how it was set. Kanga Limited. So the question is 2019, November. You can see here, November 2019. Kanga Limited is considering the design of a new conveyor system. The management must choose among the following alternatives. Alternative course of action. Option number one, the firm could sell the design outright to another corporation with payment over 2 years. Option two, the firm could license the design to another manufacturer for a period of 5 years, which is likely to be the product life cycle of the conveyor system. Number three, option number three, the company will manufacture and market the system itself. This alternative will result in 6 years of cash inflows. Cash flows associated with each alternative are as follows. So we have alternatives. Initial investment for each is given here. These are the alternative: sale, license, manufacture. Then we have initial investment. Then we have years. You can see they are not equal lifespan. Now they are not telling you to use the constant scale finite. They are not telling you to use constant scale finite. Otherwise, if they told you to use the constant scale finite, then you get LCM for the 3. That is the smallest number that both of them goes into. We have 6, we have 5, and 2. which one is the least number? 30, sindio? Wanakutana pale 30. That is the least number that all of them can go into. So that will mean that you could extend them mpaka zifike 30. Yani una extend hii mara 5. Una extend hii mara 6. Alafu hii una extend mara 15. And then all of them will be having the same period, which is 30 years. The challenge is that you don't have that time, right? And that will be so dangerous. So the examiner knows that, and the examiner is telling you, don't use the constant scale period. Just use the annuity equivalent. That is Roman number 2. But let's look at question number 1. The cost of capital has been given as 12%. Required, advise Kanga Limited on the best alternative based on the net present value ya kawaida, judge them according to the NPV, which is the normal one, and also now annualize them and tell us which one is now better. Compare and contrast your results in A above, Roman 1 and Roman 2. Is it easy? 30 years, right? So let's now try. Who can try this? Nani anaamini? Nani amejiamini? Nani amejiamini? Very easy now. Very easy. So should I do it really? But anyway, for the purpose of recording, let me just do it very fast. So the first one, they're telling you to, okay, first, these are options. You know, it is good to understand the question. I can tell you this thing was confusing people. Kitu ilikuwa na confuse people. We are just saying that this person is trying to buy a conveyor system. And what they are doing, it is either they could sell the design outright to another corporation. And when they do that, if they sell it to somebody, that person can pay them for only 2 years na story imeisha. So wali buy the machine as 400, and you see the machine price has not changed here and here, unless now when they are selling it, they sell it at 400, but now the income is 400, 500. License, they can license it 400, the income is like that. So these are the cash inflows, these are the cash outflows. So you can get NPV for the first period, the second period, the third. And because it is easy to do, we can do it very fast. So let's get NPV, which is normal for the first period. So let's say option yourself, NPV for sale. NPV for sale, we're going to have 2 years. So we have IO here, we have year 0. Then we have cash flow. Then we have discounting factor. Then we have our NPV. So let's do that. 400, 400, and 5. So we have 400, which is going out. Then year 1, 400, which is in. Then we have 5, year 2, which is 5. So discounting factor is 1. Remember, it's at 12%. So 12% is almost the same as what we did earlier. What were the figures for 12%? Discounting factor year 1. Year 1, 12%. What were the figures? 89.29. So we have here 0.8929. Get me the answer here. In the 400. That is what the examiner wants. Then this one was 0.07. It was 79. 79, 72. Yeah? So we are having 400 times 0.8929. So here we have 357, 160. And then we have 500 times 0.7972. So what are we having there? We have the 2, the 5, and 57, and 60. Minus One. So that is the NPV for the first one. You have written that, I can wrap CO. Then we have the other project. So that's cell. That is cell NPV for cell option. Option one is cell. What if they go to option two, NPV for option two? This is option one. So option two is what? License. License. So we have year 0, 1, 2, 3, 4. Then we have the cash flow. So year 0 was 400. 400. And then we are told 500, 200, 160. So 500, 200, 160, 120. Is how many years? 5. Oh, 5 years. 120. And then we have 80. 500, 200, 160, 120, 80. So our discounting factor at 12%. This one we know it is 0.8929. And then we have our 0 point. So that is for year one. This one is 0.8929. And then we have 0.7972. 7972. And then give me the other one. The other one was 0.7118. And then the second year, 6555. 0.6555. 65, 55, 63, 55, 63, 55. And then the last one, 5674. Thank you. 0.5674. Thank you. Now we have our NPV here. Let's just do it very fast. So we have here 100. For those who knows how to do it, I'm very sorry for taking your time. I shouldn't have done it. So I'm very sorry for that. Because I know it is easy. So I apologize on behalf of my students. So what do you get the total? $441 for 30. 441 for 30. So that is okay. Now, hii nyingine ni rahisi sana. Are they the same cash flows? So we can use we can go direct to our PV first, ndio? Kama cash flow iko the same. Ama ni tofauti? Si the same throughout. So si tunafanya PV first. So that is which project? Which option? Option 3, which is manufacture. Manufacture. Hii naona cash flow iko sawa, so we just get our PV first. So NPV is equal to cash flow times PV per 12%. How many years? 6 years, eh? Minus IO. IO is 900. Eh? So we can come here and say the second one is not the same. Oh, second one is not the same. Then we have to do the normal way. Kama kuna moja, hata moja yenye si the same. Oh, sasa hii ndiyo imeharibu. Sorry for that. So we have to do the normal way. I didn't notice that. Thank you. So we have to do the normal NPV, where we have to follow this for 6 years. If they were the same, we would just use PV fund. So the option is manufacture. That's option 3. So we have discounting factor. Year 0 is 900. 900. Then we have year 1. We have 400, which we agreed is 89, 29. And then you will calculate that. You'll calculate for me these ones. Please get me the answers. So this one is 500. If I remember, this was 60, was 79, 72. Then we have number 3, 500. This one is 0.7112. Then we have number 4, 0.6. It was 63, 55. Then we have number 5, 400. The rest are now the same. 0.5. You got to be 5674. Then number 6, 400, 0.5056. So let's get the figures. I can start with any. Euro 0 to 40. For 3 is okay. 3, 72. No, hiyo ya kwanza iko sawa. Number 3. Nimeandika vibaya ama? Number 4 iko sawa. Number 5. So I'm the one who is wrong, eh? Can somebody confirm for me that I'm wrong in number 3? The rest I can see we are okay. 640. Hata hii ya mwisho pia ni tofauti. So 3 and 6. 3 and 6, somebody confirm for me. Number 4, number 3, 720. So number 3 should be 720. 3, 720. And where does the problem come from? Huh? 2 and 4. Is it not 8? How comes 20 huko mbele? Which mistake have I done? Mi naona hii 2. Oh, hapa inafaa ikuwe 8, eh? 8, sawa. Sawa. And then hii ya mwisho pia nimefanya mistake. What is the mistake? 4 and 6. Naona 4. Ingine sasa sijui shida iko wapi. Okay, number 1 iko na number 1 iko na 566, eh? Okay. Oh, sawa. 566. Hapa ndio tuna makosa. 66. So that should be 640. 640. Those small mistakes are very dangerous. And then Nelson amesema mimi yako sawa. Haya. The first one, yeah, 400. Kuna mwenye amenipea hii ya kwanza. What is the figure? 570. Yeah, number 3, 57, 160. Haya. 600. So we are okay. Are we okay now? Proceed. So just add. What is the NPV? The NPV 824 to 80. Now, if you are to judge it from the layman eyes, you can be able to see that the one that has longer period has got advantage of giving a good NPV because they could live to generate more income. You can see. So manufacturing is giving us 824 to 80, but just because it lived for a longer period than the rest. The other one is giving 441, 430, and then we have 355, 760. Those are different lifespans. So it is not fair to judge them and say that from the NPV that you see, this one is better. So what we do, we now go to the second procedure of judging them. So what we have just done is the question number 1, which was the net present value for each. Net present value for each. Now, if you were to judge them, then now we go to annualized NPV, which is question number 2, annualized NPV. The annualized NPV. Sorry, what is this on the screen? So we have annualized net present value approach, which you now know. So in annualized net present value, just take the figures, then you get their PV far. NPV. The annualized NPV. So you get the first one, which is the selling option. So just say sell option. What is the alternatives? So the first alternative is sell option. You say annualized NPV is equal to the NPV of that option or PV far of the same. So that we have, we recalculated them. What was it? 3 55.760 all over PV for 2 years. Did it live for only 2 years? Yes, the project is 2 years, 12%. So get me the PV for that. What is the PV for that? Then we come to the other option, which is now the license option, which we are saying that NPV for that lower annualized NPV is equal to NPV, which is it was 441 for 30 lower the PV for that. PV for that. Somebody is assisting me here. Let me see. It is annualized NPV is 2. I wish you could give with the answer 3.6048. That is for this one. So this one is PV for 4 years. 3.6048. Can you get me this one also? 2 years tulipata 1.6. It was 1.6. Kuna mali tulicalculate hiyo 1.6 what? It was 1.6901. 901. Then you divide. This one also divide. Then we have option number 3. This is now manufacture option. And annualized NPV. Annualized NPV is 8. We got the figure to be 824 to 80 all over 4 years. 4 years is 411. The answer is those ones you can do. Those ones you can do. So let's now start a new concept. We call it a replacement analysis. Replacement analysis. Get all answers, then we can proceed. So the first one is 210 496 42. And then we have 122 456.17. And then we have the last one, 200,486.45. So when you look at it from this point, you'll be able to see that the best one that has got the highest annualized present value is 210. Not this, neither is it this one here, but is A. So you are able to see that the first way or the first method when you're using the normal NPV, we would have picked project number 3 or the manufacturing option number 3. But now after annualizing them, we realize that option number 1 is the best, which you can actually pick. So Roman number 3 is asking, can you compare the two? Compare and contrast the results. How will you explain compare and contrast the results? Then you have your, how many points? Those are 8 points. Compare and contrast your results obtained in Roman 1 and 2 above. So you can say that by comparing the NPVs of the project of unequal lives, the project with a longer period has an advantage of the highest NPV or generating the highest cash flow over a longer period. So that is the truth. Project with a longer period has got the highest NPV. It has advantage of the highest NPV as a result of generating revenues for a longer period, right? And therefore, the NPVs need to be adjusted through annualized present value. You had to adjust the NPV through annualized present value. And after adjustment, you realize that the first option, which is the sale option, has got the highest annualized NPV, which is the better, which is better. What is the PV for 4 years? Somebody calculated. PV for 4 years. Somebody calculated and got us this one. 4 years, no, 4 years we have not calculated. Did we really want it? We only have 2 years, we have 5 years and 6. 4 years we didn't calculate. But in the previous example, I think we did it. Those who did it for the last one, what did you get for 4 years? It was 3.0373. So the first method gave us option number 3, and the second one is giving us option number 1. Yes. My bad, Niko sawa. Okay, thank you. What do you mean by the same option? What do you mean same option? No, waziri umeelewa na ume-explain vizuri that the first method gives us option number 3, where option number 3, the option takes advantage of the longer period of cash flows, therefore giving us the highest NPV compared to the other ones. It has given us the highest NPV as a result of the longer periods of generating cash flows. So we are saying that we had for us to, so you say that for us to evaluate projects of an equal life, you need to adjust NPV by annualizing them. You need to adjust the NPV by annualizing them. And after doing that, after annualizing them, we realize that project A or the selling option is the best because it gives the highest ANPV, the highest ANPV, annualized NPV. I'm not sure if there is any question before we go to something that is also very interesting. The time is on our side. The time is on our side. I want us now to look at the capital rationing before we go to replacement, or maybe let me start with the replacement analysis. So say replacement analysis. So we have looked at projects of an equal life. Na hapo tumeelewa vizuri. So we call it, what do we call it? Replacement analysis. Replacement analysis. Replacement analysis. So what are we saying here? There are two ways in which this happens. We have replacement. We have replacement where you can be able to replace the project with another one. You can replace the project with another one. So umeanza kurana project, alafu unaona hapo katikati unaona hai make sense. Can we start another one or replace the machine with another one? And then we have another replacement where you don't replace it with a machine that you're going to use in the business, but you now abandon it and go to something else. You just sell it and leave it go. Or let it go. Tunaelewana? You can start a business. After starting a business, maybe you are, like now we are running an institution. So we can say that this college is not beneficial or it is not growing or we are not getting any benefit from it. The best option, we can leave it and now take the money that we have, twende kwa biashara ingine. You are totally moving away from that business. Option number two, you can be, maybe you are running the business and then you bought the machine. You can replace that machine after 5 years to buy another one, which is now better and maybe cost effective, and now proceed with the project. That is replacement analysis. So we have two ways. So let's start with the first one. Is there any person who wants to understand it better or who has not understood what I've just said? Kuna mtu ajielewa chenye nimesema tu sahihi? That you replace in two ways. You can abandon the project and start another one. So you replace that project with a totally different one. So it means that you sell it. If it was a machine, unafika mahali unauza hiyo machine, unaachana nayo because it is costly to you. You buy the machine, unaanza kupata pesa kidogo, lakini pesa inaenda tu. Unasema, let me leave it and then go to a different one. Or you say that you're replacing it. Maybe it was for around period like 8 years. After 3 years, you analyze and say, fine, I've gotten some revenues, but I think it's better I sell it now and replace it with another one to complete the remaining 5 years. So that is called replacement analysis. So this replacement analysis have got some annuity equivalent aspect in them. It has got some annuity equivalent aspect in them. So that one will be called the annuity equivalent by replacement analysis. If it is mixed, if it is not mixed, it is just replacement analysis. So let's take example, given the following, that IO, say illustration, sorry. Then you have IO is equal to 100 million. Then you have years. We have operating and maintenance cost. And then you have your resale value. So resale value is the value of the item at the time you are changing it or replacing it or abandoning it. After 3 years, your project or your machine ilikuwa na some value. It is like scrap value. You sell it at that point. That is the scrap value or resale value. So let's say that you started a project. This project is incurring you some cost. And in this case, in this illustration, we have not been given the revenues. We are only given the cost. But the next one that we're going to do, you'll be having the revenues. So this one is only cost. That in year one, you started the business. Year zero, we have the business where you're going to invest 0. And then we have 0. That is not investment, but the cost. In year 0, there is no cost. There is no resale value. You don't even have the machine. Year one, you now have the machine. Of course, year zero, sorry. Year zero, you have the machine which is value one, but you're not selling it. So the resale value is zero. You're not selling it. So you're not selling it at that point. But after year one, using the machine, you can say that it is going to cost you 120. That's the money that it has cost you. So we call it operating cost or maintenance cost of that machine. You are running the machine, it has cost you 120 to maintain it. But at that point, you say that you can sell it at 80. Our main aim here is to replace the machine. And when you're replacing the machine, you have to know the price at that time. This machine, you bought it at 1 million. In year zero, you are not intending to sell it. So even the sale value is zero and it does not incur you any cost. But after 1 year, it has incurred you a cost of 120 to maintain it. 120 to maintain it. But you are looking at it and saying, I bought it at 100 million, but now I can sell it at 80. Right? Then year two, sorry, in year two, it is going to incur you additional 130 cost. But this time around, you can resell it at 65. In year three, you can still have it. It is going to cost you 140. Then you sell it at 35. If you are to sell it after year three. So these are the resale value for each respective years. Now, if you are told now to perform the annualized equivalent value using replacement analysis for each year, is called year one cycle, year two cycle, year three cycle. Can you do annualized equivalent replacement value or annualized equivalent value replacement analysis for year one, year two, year three cycle? Year three cycle or year one cycle will mean that you assume that you only use it for year one, decide to replace it or sell it. Or you can proceed up to year two, you decide to sell it. That is called year two cycle. Then we have year three cycle. So the requirement is get the annualized equivalent value replacement analysis for year one, year two, and year three cycle. Wewe unaamua after 1 year hii kitu afadhali niuze. Hii kitu nauza. Alafu nasonga kidogo. Year 3 hii kitu nauza. Are we okay up there? Kama uko sawa, beba mkono. So are we okay? So the first one, I want to do the first one and then you guys try the second one. I'll just leave this example here, this many, the illustration there. So what we do, you have a solution, then we have a 1 year cycle, 1 year cycle. So you have year one, we have the cash flow, we have PV at what? At 11%. Let's use 11%. I did give that. Then we have present value. Of course, they will give you the rates. So use PV at 11%. So we have year one. So in year zero, when we're just starting, we have 100, right? Then we have one. This one should have been 100 million, so even these ones are in millions. And then millions, 80 million, millions. So we have the first one, money going out. So this 100 is money going out still. And then 120 in year one, you spent 120. So you spent 100 and then 120. Then here PV for kawaida is this one. What is the PV for year one? At 11%. Can somebody get 11% for year one? Hundred is the initial outlay. 100 million that is given in the instruction check. Year zero, initial outlay is 100. In the question, the machine. Somebody has a question somewhere? The machine must be very expensive to operate and maintain. Yes, these are imaginary. So you have 0.9001. So where you may run machine, this is the cost of maintaining the machine, not the operation, the normal cost, but for you to operate and maintain the machine, that is the cost, not the cost of buying and selling goods. So that is what we're given. So we have here 100. Get me that one. What are you getting? When you multiply. Now at the end of year one, umeamua kuuza. Wewe umechukua tu 1 year and then you are selling it. So you are selling at 80. So this one is income. This one is a cost. So we are going to have the same one here. So get me the answers. Get me the answers. So we have 108, 180, 108. Okay. That is money going out. Maintain. You want to sell it. Umeamua kuuza. Unauza how much? 72, 707. In fact, these are dots. So we have 72, 07. What is the NPV? The NPV for that project? You gotten this. So can you do for me for a year? For 2 years cycle. I can have this then. So 2 years cycle. Sorry. Yeah. So the second year period, you're going to have the same things the way we have done it, but now you are not selling here. This is now second year or 2 years. 2 years period. 2 years cycle. The first year the same way. First year you're going to spend this. Now second year here you're going to spend another one. Bado haujauza. Mwaka ya kwanza umeincur cost, haujauza. Mwaka ya pili una incur cost again 130. But now the discounting factor for the year has changed. Still, so put the discounting factor for year 2. I don't know the figure. Then now you are selling it in year 2. So year 2 you are selling at 65. So we need to have income which is 65, right? And then we have discounting factor for year 2. So what is the discounting factor for year 2? $08,116. So multiply. The concept here is that you have the initial outlay, then you have the year 1 expense, year 2 expense, alafu unauza in year 2. The other one was year 1 expense, and then you sell in year 1. So that year 1 was having some income or inflow. So this one, inflow comes in year 2. Year 1 and year 2, kuna outflow, and then it's same year 2, you now sell it. So you have resale value. So get me the final figure there. So what you get are the new NPV 260, 820, 862. So 260, 862. That is the new. Can we go to the third year cycle? 3 years, because you can see the machine has gone up to 3 years. So 3-year cycle. Three-year cycle. So again, we move up to year 2, but now you don't sell in year 2. You don't sell in year 2. You're going to sell in year 3. But first, we need to know the cost. So you're going to incur 140 before you sell it. And in year 3, what is the discounting factor? Discounting factor for year 3. Here we are also going to sell. So that is money coming in. Discounting factor for year 3. What is the NPV for year 3? NPV for year 3? Okay, so can we now do the annuity equivalent? For the first year. Annuity equivalent for the first year. Cycle, year 1 cycle. We have LTV, lower PV per 11%. How many years? 1 year. Which is the same as ilikuwa negative. Negative 136.04 all over 9 or 0.9009. So hiyo unapata ngapi? Then we go to year 2 cycle. Year 2 cycle. So in year 2 cycle, the unit equivalent is NPV all over PV. PV for 11%, 2 years, which is now somebody to calculate for me. What did we get? We got negative 260.88. All over, what is the PV for? 151, eh? 151.0. So. Thank you. What do we get here? PV for year 2. I think tukimaliza hivi we can stop there because you guys umeanza kulala. Malizia hapo tuende. I need PV for 11% year 2 or 2 years. What is it? Okay, this 1.70. 1.7125. So giving you the answer is 152.23. 133. 152.33. And then we get the year 3 one. Year 3. Year 3 cycle. We have now NPV or PV for year 3. PV for 11%, 3 years, which is now giving you negative 390.392 all over. What is the answer there? All over what? 2.4437. What do you get as the answer? What do you get as the answer? 159.75. Negative 159.75. Now, the one that has got the least ENPV is the best option because it is more positive. So which one is it? 151 is here. So using that, you can take 151. You can take option in a 1 year period. So you can replace it after every 1 year. Replace the machine still. So buy the machine after 1 year, you buy another one of the same type. After 1 year, you buy another one because it's going to give you the least loss. The least loss or the highest NPV compared to these other ones. So we can stop there. I wish we had more time and energy, but I know you guys are tired and it is a weekend. You need to prepare for Monday. I'm loving it that you guys are getting more and more. So unless there is any question. Yes, hapo we are not looking at the money, but the next example that I wanted to do, though it is late, that one has got money. Iko na pesa sasa. So look at another example that I've given you. Somebody can try it. We can't do it now because of time, but I want you to try that question. Which setting was it? AFM The first example. The first example is quite easy. Yes, Bidco. Yes, that one. Is it Bibco or not Bidco? It says that for the purpose of those who are going to watch the recording, it says that Bibco, B-I-B-Co. So Bibco is a manufacturing company which makes a wide range of products. That is number B, a wide range of products. One of these products requires the use of a special machine. The current policy of Bibco is to replace each machine at the end of its useful life of 4 years. The directors of the company are considering whether to replace the machine more frequently due to the fact that its productivity declines and running cost increases as it gets older. There is insufficient demand for the company's products manufactured using the machine to justify purchase of a second machine. Bibco Limited sells the products made by the machine at 12 shillings each, at which price it is able to sell up to 500,000 units per annum. Variable cost, excluding machine depreciations and running costs, amount to 4 shillings per unit. Details of the production capacity and running cost of the machine are given as follows. So we have their year of machine, year 1, year 2, year 3, and 4. In year 1, production capacity is 500,000, while running cost is 500. Year 2, production cost is 500,000, the running cost is 650 shillings. Year 3, the production cost is 400,000, when the running cost is 750. Year 4, production capacity is 400, while running cost is 900. The cost of buying the machine is 6 million. The resale values of the machine is 4 million for year 1. That is for year 1 old machine. To 2,500 or 2.5 million for 2-year-old machine. Now I hope you are unaelewa hizo. So we have the resale value. You put year 1 is 6,000. Year 2, 2.5 million. No, year 1 is 4 million. Year 2 is 2.5. Year 3 is now 1 million. The way we did the other one. For a 3-year-old machine is 1 million. And 0 for a year 4 old machine. It means that after year 4, the machine should have been fully depreciated and you cannot resell it. So there is no resale value after year 4. It will be fully depreciated. The company provides depreciation for its non-current assets, that is including the machine, in a straight line method. All costs and revenues are paid or received in cash at the end of each year for which they relate, except the initial cost of the machine, which is paid immediately on the purchase. The company has an annual cost of capital of 10%. Advise the directors of Bibco on whether to replace the machine every year 1, year 2, or year 3, or year 4. That one they want you to perform the analysis and tell us whether they should be replaced in year 1 cycle, year 2, or year 3, or year 4. So therefore there, you also need to perform the annuity equivalent for year 1, year 2, year 3, year 4 cycle. So for you to perform the annuity equivalent, obviously you need to get the NPV for year 1, year 2, year 3, and then you get the annuity equivalent for the periods. That one looks simple. I'm sure you can do that and share with me on WhatsApp. But don't worry, we can get time and do it. Otherwise, thank you so much. Have a good night. So I can close the meeting. I know Waziri will not go before I click the end button, because she thinks that I'll give something else that is very important. Nothing now. Just have a good night. Sasa.